You're listening to Earnings Unscripted, where we unpack what really happened in today's earnings, minus the corporate buzzwords. It is January 26th, 2025. I'm Susie, and today we are looking at Baker Hughes for the fourth quarter of 2025. And honestly, Miro, looking at this report, it feels like an identity crisis, but in a good way. Like they're deciding whether to be an oil company or a power company.
Or they're just realizing that electrons pay better than molecules right now. Hi, Susie.
Hi, Miro. So, give us the headline. Was it a good quarter?
It was solid, actually better than solid. Top line came in at $7.39 billion. That is up 5% from the third quarter. Earnings per share hit 78 cents, which beat expectations, and is a nice jump from the 68 cents we saw in Q3. But the real kicker is the margins. Adjusted EBITDA margins hit 18.1%. That is a record for them.
18% is hefty for heavy industry. And just quickly, before we get too deep, standard disclaimer, this is definitely not financial advice, just two friends obsessing over numbers. Do not trade based on our caffeine intake.
Please don't. My portfolio is strictly experimental.
So the market liked it because I saw it looked a bit wobbling in the pre-market.
Yeah, it was a classic sell the rumor, buy the news reversal. The stock had been sliding for the last month, down about 5% in Q4, and pre-market this morning, it dipped again to 54.50, but the moment the call started, vertical, bought all day long, closed near the highs around 56.3. I think the traders realized the bad news in oil was priced in and the good news in power was underestimated.
Right, and that's the hook, isn't it? Because when I skim the segment breakdown, it looks like two different companies. You've got the traditional oil field stuff, OFSE, which seemed tired.
Tired is polite. It was soft. OFSE revenue was actually down 2% quarter over quarter, $3.57 billion. North Sea is down. Mexico is weak. They are cutting costs just to keep margins flat. But then you look at IET, industrial and energy technology, that's the gas turbines, the compressors, the fun stuff. That was up 13%. Margins hit 20% for the first time. Basically, the drill bits are struggling, but the power plants are printing money.
It's like watching a baton pass in real time, from drilling holes to powering the cloud. Because I saw a stat in there that blew my mind, something about being sold out.
Yeah, this is the big one. Management basically said their Nova LT gas turbines, which are crucial for off-grid data centers, are effectively sold out through 2028. If you want a turbine today, take a number and wait 3 years.
That is wild. Sold out for 3 years. And that connects to the AI story, right? Because usually when industrial companies talk about AI, I roll my eyes. It feels like they're just sprinkling magic dust on a rusty machine, but this feels tangible.
It is tangible. They doubled their data center order target. They're now looking at $3 billion in orders just for data centers between 2025 and 2027. That is not marketing fluff. That is backlog. They are solving the bottleneck, which is power availability.
So the narrative is shifting from how many wells can you drill to how many gigawatts can you keep online?
Exactly. And the market is finally giving them a multiple for that.
Okay, so we have a record margin, a sold-out turbine shop, and a soft oil patch. But I want to know how real that $3 billion number is, or if it is just optimism with a spreadsheet. Let's get into the details.
See, I don't think it's just spreadsheet optimism this time. I think it's structural desperation from their customers.
Desperation? That's a strong word for a corporate earning.
It fits, though. Look at why that $3 billion target exists. It's not because Amazon or Microsoft suddenly love gas turbines. It's because the utility grid is too slow. If you're building a gigawatt-scale data center today and the local utility tells you, sure, we can hook you up in 7 years, you don't wait. You build your own power plant right next to the server rack.
Okay, right. That's this behind-the-meter phrase they kept using on the call.
Exactly, behind the meter. It basically means we are bypassing the grid entirely. And Baker Hughes is sitting there with the Nova LT turbine, which is perfect for this, saying, we can help you, but the line starts in 2029.
So they've become the bouncer at the club of electricity.
Pretty much. And that leverage shows up in the margins. You don't hit 20% EBITDA margins in heavy machinery by giving discounts. You do it because you have pricing power. The customers aren't asking how much anymore. They're asking how soon.
Which sounds great, but I mean, isn't there a ceiling there? I mean, if they are literally sold out through 2028, that's it, right? They can't just conjure more turbines out of thin air. So their growth is physically capped by their factory walls.
That is the risk. You nailed it. Management said they are bringing new capacity online, but not until the first half of 2027. So for the next 18 months, they are effectively capacity constrained. They can squeeze price, sure, but volume is locked. It's a high-class problem to have, but it's still a problem. If a customer needs power now, and Baker says, wait 3 years, that customer might go call Siemens or GE.
Or just buy a bunch of diesel generators and hope nobody notices the emissions report.
Which happens more than you'd think.
I bet. Okay, so the industrial side is a sold-out Ferrari dealership. But what about the messy part? I was looking at the 2026 guidance, and honestly, Mero, it confused me. They're guiding for revenue around $27.25 billion. Isn't that lower than 2025?
Okay, I was hoping you'd ask this. This is where the headline number is a total optical illusion.
Oh boy, here we go.
Now, listen, it's important. If you just look at the top line, it looks like they're shrinking. But you have to strip out the divestitures. They sold off the precision sensors business, and they deconsolidated surface pressure control. That's like, chopping off a limb that weighed $1 billion.
A limb that wasn't growing.
Exactly. A limb that was dragging them down. If you adjust for that missing $1 billion, their organic growth is actually mid-single digits. They are getting smaller on purpose to get more profitable. It's not a revenue decline, it's a portfolio cleanup.
So less bloat, better margins.
Right. And that's why the free cash flow nearly doubled to $1.34 billion this quarter. They're becoming a leaner, cash-generating machine rather than just a massive oil services conglomerate.
Okay, that changes how I read the guide. I saw flat revenue and thought stagnation. But you're saying it's actually pruning.
It's pruning. But look, pruning is painful. It makes the tree look smaller for a season. The market usually hates that. But today, they bought it.
Because they trust the gardener?
Or because they really, really like the cash flow fruit.
Okay, terrible metaphor. I take it back. But this brings up a bigger question for me. We have this lean, mean, power-generating machine, but we still have half the business tied to drilling oil wells in a softening market.
Yeah, and that tension isn't going away.
So let's step back for a second and think about what all this means for their actual identity going forward.
It's not. Think of it as a hedge. The oil business, OFSE, is the cash engine. It's mature, it's cyclical, and frankly, it's facing a soft patch until at least 2027, if you believe the CEO. But it generates the cash that lets them build out the power side without borrowing a fortune.
So the old economy is literally fueling the new one? It's poetic in a gritty kind of way. But does that split focus worry you? I mean, managing a declining oil patch and a hyper-growth tech cycle at the same time, that is a lot of mental bandwidth.
It is, but look at the execution. They cut costs in oil just enough to keep margins steady at 18%, even while revenue dipped. That is disciplined. They aren't chasing unprofitable barrels.
They're hugging the curve.
Exactly. But looking ahead to 2026, that is where the rubber meets the road. They have this massive backlog. They have the sold-out signs up. But now they have to actually build the things. And management dropped a quiet little warning about higher tariff-related costs next year.
Ah, the tariff ghost. I wondered when that would show up.
It shows up everywhere. If supply chains get sticky or expensive, that 20% margin in IET could get squeezed. It's the classic industrial trap, selling more than you can efficiently build.
So, the verdict?
I think they are the adults in the room right now. While everyone else is shouting about AI revolution, Baker Hughes is just quietly selling the batteries for the flashlight. It's not flashy, it's not a moonshot, but it's remarkably, competent.
Remarkably competent. High praise coming from you, Miro.
I have low standards for excitement, you know that.
Well, boring is beautiful when it pays the dividends. All right, let's wrap this up before we start analyzing the font choice in the slide deck.
The kerning was actually decent.
Oh my God, save it for the newsletter. Right. But before we sign off, I want to take a quick moment to pull back the curtain on what this actually is. Earnings Unscripted is an experiment by a small team of enthusiastic people exploring the frontier of AI and how it can be used to enrich us. This entire episode was created by a team of AI agents, from the research analyst digging through the filings, to the scriptwriter crafting the dialogue, to the fact-check and QA specialist, and yes, even the voices you are hearing right now. We are all working together to deliver high-quality, up-to-date information that would hardly be possible otherwise. If you have questions, comments, or just want to see what else we are building, reach out at earningsunscripted@datamadness.ca or follow us on X. Thanks for listening.
See you after the next call.